Welcome back, everyone. Thank you so much for joining us. Please make sure you're subscribed to Newsix Brief for more exclusive content. It just takes a second to subscribe, and I would absolutely love to see you there. Here's what just happened in gold and silver, and why this was not exactly a normal correction. You may recall several days ago, on January 30th, the precious metals market experienced one of the most violent sell-offs in modern history. And yes, this happened several days ago, but I've seen quite a bit of misinformation about the event and the reasons behind it. So I wanted to dedicate a full video to it, and walk you through what happened and the red flags you need to be on the lookout for. Gold dropped 9% in a single session that day, falling from around $5,390 an ounce to just under $4,900. That was the steepest one-day decline since the early 1980s. Silver was hit even harder. At one point, it was down more than 35%, the largest one-day collapse on record. If you look at gold and silver together, they wiped out roughly $7 trillion in combined market value in a single day, in 24 hours. $7 trillion in market value disappeared within 24 hours. That kind of move doesn't happen because one data point surprised the market or because fundamentals suddenly changed overnight. This was a positioning shock, not exactly a fundamental reset. And to understand why this happened, you have to look at what came before it. In other words, you have to dig a bit deeper. Gold and silver weren't just rising. They were in a full-blown momentum surge. Over the past year, silver had risen from roughly $31 an ounce to over $116 an ounce, a gain of nearly 280%. Gold almost doubled, climbing from around $2,760 to over $5,400 an ounce. In January alone, gold gained nearly 30%, and silver surged almost 70%. By late January, both markets were extremely overbought. And this is where you need to start paying attention. By late January, both markets were overbought, heavily crowded with speculative positions, and effectively supported by increasingly euphoric sentiment. Remember those videos that try to convince you that gold is going to replace the US dollar? Well, that's a great sales tactic. It works just fine. Some people make millions on that, but others are actually left holding the bag. And I would argue that there are more of the latter than those who make millions. Leverage had actually piled in at that point in time, just when so many people were trying to buy gold because they thought they would get rich or this would be some sort of way to gain substantial profit. Momentum traders were chasing quick profits, and the volume of stop losses was concentrated. This is the exact setup for a violent unwind. What's not surprising, and what should be perceived as a major red flag here, is that despite these financial realities, the immediate catalyst was not financial. It was political. It all goes back to Washington. The surprise designation of Kevin Warsh as the next Federal Reserve Chairman was interpreted as a hawkish shift. Whether or not that interpretation ultimately proves correct is almost beside the point. I personally believe that it's not, because I don't think there's going to be some type of revolution as far as Federal Reserve policy is concerned, and I explained my position and the reasons behind it in great detail in a recent video here on Newsix Brief. What mattered at that point in time was that it appeared to reduce perceived political and policy risk, at least temporarily. And that alone was enough to take the wind out of a market that had been pricing in rising instability as a one-way bet. And here's the most interesting part. Once prices started to fall, volatility spiked, and that triggered automatic selling from leveraged players hitting margin limits. As prices dropped further, stop losses were hit. Margin calls followed, which means forced liquidation accelerated the move. Liquidity vanished just when everyone needed it the most. And this is what analysts mean when they say this was a liquidity event, because it was. Most importantly, nothing fundamentally broke. Inflation data didn't suddenly collapse. It didn't improve. It didn't deteriorate. Monetary policy expectations didn't reverse overnight either. Central banks didn't announce they were dumping gold. That's the uncomfortable lesson here. Gold and silver didn't fail necessarily as safe havens. They failed as overbought trades, as overbought assets. In other words, when too many investors pile into the same defensive asset, or any other asset for that matter, when they use leverage, it actually stops behaving defensively. This shows you that even buying safe haven assets, even buying gold or silver or platinum, for individual investors may be very, very risky. You have to know when to buy. And if you follow those overhyped so-called experts who effectively just push gold no matter what happens, you may lose a lot of your hard-earned cash while they profit off of you effectively buying into the next imaginary crisis. Now, another question to ask here would be, can gold's bull market actually continue? And the honest answer, based on everything I'm reading, is it depends. That's the answer. It depends. Let's look at both sides. On the bullish side, if central banks continue buying gold at quite aggressive levels, as they have been, that's a clear positive. If macro uncertainty stays elevated, and we're talking about geopolitics, fiscal stress, financial instability, that trend actually supports gold as a hedge. And if interest rates eventually move lower, which it looks like they will with Kevin Warsh being at the head of the Fed, that historically may help gold prices as well. Lower rates reduce the opportunity cost of holding gold instead of interest-bearing assets like bonds. So naturally, gold will benefit from that. But the dollar also matters. Gold and the US dollar actually tend to move in opposite directions over a long period of time. So if the dollar continues to weaken, which I believe it will, that alone could actually act as a tailwind for gold prices too. But here's where things get uncomfortable, and you need to pay attention here. Gold is not exactly a get-rich asset. I know that's how it's been presented, but it's not. Gold isn't cheap anymore. Research indicates that gold prices tend to revert to the mean over long periods. When gold trades far above its inflation-adjusted average, future returns have often been disappointing. We've seen this movie before. For example, in 1980, gold prices spiked to extreme levels, only to be followed by a long stretch of poor performance through most of the 1980s. The same pattern played out after gold peaked in real terms in August of 2011. What followed wasn't a quick dip. It was a multi-year decline from 2013 through 2015. Today, gold is once again trading near an all-time high. In inflation-adjusted terms, it's roughly 3 times its long-term average. I will repeat that. In inflation-adjusted terms, gold at this point in time is roughly 3 times its long-term average. That doesn't mean prices must collapse tomorrow necessarily, but it does suggest that the margin for error is very, very thin. And now is likely not the time to purchase unless you're able to tolerate and absorb a significant level of risk. Another reason for caution is gold's tendency to move in long, extreme cycles. It tends to boom or bust. The late 1970s were a boom, but the busts can be brutal. From late 1980 through early 1985, gold fell by more than 17% per year on average. And after a decline that began in 1987, gold did not fully recover in inflation-adjusted terms until 2005. That's nearly 2 decades of effectively dead money. This is where gold's reputation as a safe haven can be very, very misleading to people who don't do their homework. Gold is often thought of as stable, but historically it has been volatile. Part of this comes down to what gold actually is and what it's not. Gold doesn't produce cash flow. It doesn't pay you dividends. It doesn't compound. As Warren Buffett famously put it, gold just sits there and looks at you. And that could be exactly what you want if your goal is to preserve purchasing power during uncertain times. But it's not ideal if what you want is to create wealth. So with that being said, I'm not telling you to write off gold. I'm not telling you not to purchase it. My point is, do your research, do your homework, and make sure you adjust based on your personal circumstances and on how much risk you're actually able to absorb. If something were to happen, for example, a drop like I described in the very beginning of this video, would you be okay? Would you be able to absorb it and move on without taking a substantial loss or it affecting your lifestyle? Those would be good questions to ask and to find answers to. Now, let me expand on what this really means for investors trying to navigate volatile markets and why understanding the mechanics of these crashes is essential for protecting your wealth in turbulent times. Because what happened on January 30th wasn't just a gold and silver story. It's a cautionary tale about speculation, leverage, and the dangerous psychology that forms during euphoric market runs. The first critical lesson is understanding the difference between a fundamental investment thesis and a crowded trade. Gold has legitimate fundamental support right now. Central banks are buying at historic rates. Geopolitical tensions are elevated. Fiscal deficits across developed economies are enormous. Currency debasement concerns are real. These are all valid reasons to own gold as part of a diversified portfolio. But when an asset's price rises too far, too fast, something insidious happens. The narrative shifts from, "This is a prudent hedge," to "this is how I'm going to get rich quick." Momentum traders pile in, not because they understand or care about the fundamentals, but because the price is going up and they don't want to miss out. Leverage amplifies the moves, creating a self-reinforcing cycle where rising prices attract more buyers, which pushes prices higher, which attracts even more buyers. This is classic bubble psychology, and it happens in every asset class: stocks, real estate, commodities, cryptocurrencies. The fundamentals that initially justified the investment get overshadowed by pure speculation. People stop asking, "What's this worth?" and start asking, "How high can it go?" And here's the thing about leverage. It works both ways with brutal efficiency. When prices are rising, leverage amplifies your gains and makes you feel like a genius. A 10% move in gold becomes a 50% or 100% gain on your leveraged position. It's intoxicating. But when prices reverse, that same leverage magnifies losses catastrophically. A 10% drop can wipe out your entire position and trigger margin calls, forcing you to sell at the worst possible time. This is exactly what happened on January 30th. The market was loaded with leveraged long positions, all betting that gold and silver would keep rising. When the catalyst hit, the Warsh appointment, it didn't matter whether the interpretation was correct or whether the fundamentals had actually changed. What mattered was that it gave leveraged players a reason to take profits or cut losses. Once the selling started, it triggered a cascade. Stop losses hit, forcing more selling. Margin calls hit, forcing even more selling. Market makers widened spreads because they didn't want to catch falling knives. Liquidity dried up precisely when it was needed most. And in that environment, prices can fall much further and much faster than fundamentals would justify. This is why I'm so critical of the YouTube channels and social media personalities who relentlessly hype gold and silver as can't-lose investments. They're not providing investment advice. They're selling a narrative that benefits them financially, either through affiliate commissions on gold dealers or simply through the ad revenue they generate from clickbait videos with titles like "Gold will replace the dollar" or "Silver to $500. These people prey on fear and greed. They present complex macroeconomic situations in black and white terms. Either you buy gold and survive the coming collapse, or you hold dollars and get destroyed. There's no nuance, no discussion of valuation, no acknowledgement that timing matters, no mention of the risks involved. And their viewers, often people who are genuinely worried about the economy, about their savings, about their family's future, take this advice at face value. They load up on gold at $5,000 an ounce or silver at $100 an ounce, convinced they're making a smart defensive move. Then when the inevitable correction comes, they panic and sell at a loss, or they hold through years of declining prices, watching their purchasing power erode despite owning the supposed safe haven. The reality is that gold is neither a magical solution to all economic problems nor a worthless rock. It's a finite physical asset with unique properties that make it useful as a store of value and a hedge against specific risks. But like any asset, its value relative to other assets fluctuates based on supply, demand, sentiment, and macroeconomic conditions. When you buy gold at 3 times its long-term inflation-adjusted average, you're not making a defensive investment. You're making a speculative bet that either fundamentals will justify an even higher valuation, or that sentiment will remain euphoric long enough for you to exit at a profit. That might work out, but it's not the same as buying gold at fair value as a prudent diversification strategy. This brings us to the question of whether gold's bull market can continue. As I said, it depends. If central banks keep accumulating, if geopolitical tensions escalate, if fiscal situations deteriorate further, if the dollar weakens substantially, yes, gold could go higher. But these are big ifs. And even if they all happen, there's no guarantee the price will continue rising smoothly. Market dynamics matter. Positioning matters. Sentiment matters. You could have all the fundamental support in the world, but if the market is too crowded and leveraged, you'll get violent corrections that shake out weak hands regardless of the underlying fundamentals. And here's something most gold promoters won't tell you. Those corrections aren't just scary, they're necessary. They reset positioning, clear out speculation, and bring valuations back to levels where genuine fundamental buyers can accumulate. After a healthy correction, the next leg higher tends to be more sustainable because it's built on a more solid foundation rather than pure speculation. So what should individual investors do? First, understand your why. Are you buying gold to preserve purchasing power over decades? then short-term volatility shouldn't bother you much. Are you buying gold hoping to double your money in the next year? Then you're speculating, not investing, and you need to size your position accordingly. Second, never use leverage for long-term holdings. Leverage is a tool for professional traders who can monitor positions constantly and have the discipline to cut losses quickly. For long-term investors, leverage turns inevitable volatility into portfolio-destroying losses. Third, ignore the hype. Whether it's coming from gold bugs promising the moon or skeptics calling it a barbarous relic, make decisions based on valuation, fundamentals, and your own financial situation, not on fear or greed stoked by people with financial incentives to push a particular narrative. Fourth, diversify. Gold can be part of a portfolio, but it shouldn't be your entire portfolio. The reason to own gold is precisely because it behaves differently from stocks, bonds, and real estate. But that differentiation only provides value if you actually own those other assets too. And finally, be honest about risk tolerance. Could you handle watching your gold position drop 30% in a day? If not, you're either sized too large or gold isn't the right investment for your psychological makeup. There's no shame in that. Knowing your limitations is a sign of wisdom, not weakness. The January 30th crash was a wake-up call. It showed that even safe haven assets can experience violent drawdowns when positioning gets extreme. It showed that leverage can turn a manageable correction into a devastating loss. And it showed that following hype narratives without doing your own homework can leave you holding the bag while the promoters profit. Learn from it, understand what happened and why, and use that knowledge to make better, more informed decisions about how you protect and grow your wealth in an uncertain world. Thank you very much for watching Nuzik's Brief. I hope this video was interesting and that you learned something new from it. I certainly hope so. Make sure you like, subscribe, and share if this content is valuable to you. And I would love to see you in the next video. Take care.